Welcome, invested students, to another episode of the Invested Teacher Podcast. So, I was sharing a story with you guys. My father in law, who I love dearly, constantly reminds me that he bought his very first house for $45,000.
Right. I
And
think, yeah.
this, I mean,
Hmm.
he's 70-ish, somewhere around there. So it was a
All
while
right.
ago.
All
But,
right.
one of the things we hear so often with my clients in real estate, with real estate investors, is that they wish they had bought before. They wish they had bought when
Mm.
things were cheap, or they
Timing.
complain that, things are so expensive. We've got some people hoping for an economic crash. We've got other people that just, they're just in a cycle of sort of wishing that things were cheaper and lamenting that things were cheaper before. And today I want to talk about, that as an excuse that we use to keep us from moving forward. Because on the flip side of my father-in-law's story, I always say, Bert,
Hmm.
but you sold your last house for $1.2 million. So you can't argue both sides of that, right? And I think it's the same for all of us. When we talk about, I wish I'd bought more houses 10 years ago. I wish I had started investing earlier. It was so much cheaper before. Was like, are prices as good now as they were 3 years, 5 years, 10 years before? Maybe not, but is real estate investing still a good thing? Yes, absolutely. And I think a lot of people out there are getting stuck on this idea that real estate is too expensive, that they can't find an entry point, that they're waiting for a crash, that they're waiting for prices to come down. And I think for so many of our invested students, people are getting really hung up on that.
Yeah. And so Matt, you feel like right now it's like you're hearing about like this timing, I want to time the right move. Like when is the right time here to get in? Like you're feeling like this is a barrier to someone taking a step. Like if I'm listening right now and going like, yeah, I've been listening to these guys, I haven't taken a step yet. Like, are you saying like this might be a barrier that our folks here that are listening need to kind of like get past? And that also, if I've taken the step, maybe they talk to people on a regular basis that they can help them with this step. Is that what you're saying? Like this is a big barrier here?
I think it's a common refrain. I think it's actually become an excuse for a lot of people. And my question is like, what
Right.
exactly are you waiting for? So if John, you're waiting for prices to come down, well, exactly how much are you waiting for prices to come down for? Is it 1%, 3%, 5%, 25%? Like, what exactly are you waiting for? Like, we deal with friends, colleagues, family members who have been talking about investing for years and for years and for years, and they haven't done anything. And I think now it almost becomes a control exercise for them, saying, like, oh, it's too expensive. I can't invest right now. I'm going to wait for things to come down. This is a marketplace, just like the stock market. The real estate market is a marketplace that we can't control. And yet I think people want to control it. And so it turns into a complaint excuse or a complaint mechanism for that. And real estate has only ever gone up and up and up over time, and it will continue to do so. And so I think this is almost about calling people out to say, like, hey, what are you waiting for here to get involved in the game? And if you're waiting for prices to change or come down, what is that exactly? What specifically does that look like for you to make that choice to jump in and get involved?
You know what I would really love to ask Bert? What was the price? 45,000 you said that he bought that?
45,000,
So
45,000.
45,000. Here's something that I wonder if Bert remembers, if whether he thought at the time he got a deal, whether he overpaid,
I bet you
or
didn't.
whether he was like right in the middle, you know?
Because
Yeah.
I'm sure.
Good question. Good
Well,
question.
I bet you he thinks, oh, I bought at the wrong time because interest rates were super high.
Well, like
my
I
parents
guess I'm
bought.
asking now. Yeah, like now I almost feel like he probably doesn't think about that at all. But if you were to like take time travel, do the whole Back to the Future thing or whatever, and go all the way back, and in that moment, you're probably right. Like he probably was like, I don't know if I can afford this. I don't know if the interest rates are too high, or maybe I could have got a better interest rate at that bank. Like all of these things that are like big issues for us, like big holdbacks, are not coming up now. And kind of like the piece that I think is really important for us to look at, like when you zoom out, now that's a pretty dramatic zoom out, right? Like when you think about him and his first house, and, you know, who knows how old he was, whether he was 25 or whatever. So that, you know, over 50 years ago, potentially, that this happened. But the reality is that as time passes, it matters less and less. So, you know, like if you do it now, it matters a whole lot. But the interesting part is when we look at inflation, sure, you can look at, you know, the CPI number, you can look month to month and you could see whether it's up or it's down or it's whatever. But the reality is that even when house prices do drop, like they did drop over a period of time here in the past year, but that's from like massive growth, you know? So it's like, if you bought at that very peak, then yeah, like you're underwater. And there are people who are quote unquote underwater, but if they were buying an investment and the investment was cash flowing when they bought, they are still cash flowing today, unless they had, you know, less than like a 1 year or they had, you know, a variable and, you know, they had poor terms or whatever it is. But the reality is that if you weren't buying for speculation, you were in good shape. And then Matt, the part that like I'd like you to elaborate on a little bit here, because I think you do such a great job of discussing this idea of like, for those who are buying, say, a primary residence, which many of your clients are looking for primary residences. You also help investors, but, you know, typically people are coming and they're looking for their own home, which for the majority of people, they're not thinking like, I'm going to live here for a year and then move on, or even 5 years. Like for most people, they're buying the next house in their life and they're envisioning at the time that that's their forever home. That's like what most people do. And then they change their mind later in many cases. But the reality is like, they're not like looking for a quick exit in 12, 18, 36 months. And yet you still find even people in that world struggling to be able to make a choice and actually buy, when in reality, when you kind of zoom out like you did for Bert, it's sort of like, does it really matter all that much if you were to wait, right? Like it seems like more of like a gamble to wait, hoping that things change, rather than just if it's the house that you really want and you can afford it, then go for it, you know, instead of like just trying to be a bargain shopper.
100%. I had this conversation with a client just yesterday. He said, Matt, I felt like I bought at the peak and I feel like I maybe paid too much and I worry about getting it back. And I said, you have to change the way you're thinking about your house. It's not an investment. You didn't buy an investment property. You bought a home for your family, a place to raise your kids, make your memories, and actually live. And I think as Canadians, we've been so spoiled since, you know, March of 2020, that pandemic. In terms of the real estate appreciation, we're up like 36% from March of 2020. And so we've been tricked into thinking that our personal primary residences are actually investment vehicles. And it's not supposed to be like that. Like we've got it mixed up. We've got it confused. And so, you know, after we talked about it, he said, you know what? You're absolutely right. Because he said, I'm freaking out. I didn't know what I should renovate, what was going to be worth it or not. I said, no. Calm down and enjoy your home for the reasons you bought it, which was to raise your beautiful family, to make memories. And the good news is, over time, real estate always goes up. If you bought your primary residence with the intention of turning it around in 6 months or 9 months or a year, well, then yeah, you might be in some hot water, because then you're totally at the whim of the market. But if you bought it to live there as with your family, as you should have, then you're going to be 100% fine. So I think we've gotten confused about that. And, you know, sometimes I'll talk to sellers that, like, to put it very bluntly, you know, it's almost like they're being greedy. Like, you know, a seller who bought a house for $280,000 in 2019, you know, and didn't do any work to it, you know, turned around and you'd say, Matt, I want 500 grand. And I'd say, okay, well, let's look at what the market looks like right now. And we'll put it on the market for that. And we'll try to get you that. And then we'll stay in touch weekly and I'll say, okay, here's how many showings we've had. Here's what the feedback has been. Oh, I think we need to talk about a price reduction. I'll say, what I want 500 grand. And I'll say, seller, Mr. and Mrs. Seller, you haven't actually done anything to increase the value of your home. You've relied completely on the market for your appreciation. And just
Mhm.
like your home is appreciated, we now need to look at the market for the information about what your home value is. You don't just get to pick a number out of thin air and decide that's what your home is worth. That's being in that emotional headspace and saying, I
Mhm.
just like the
Mhm.
sound of 500 grand. I
Yeah, I
had someone
feel
tell me
like
on the
that's
phone
my
today.
house value.
Yeah, I had a consultation today on the phone with someone who said, I want 500 grand in my pocket. And I said, I'd love to get you 500 grand. Like, that's winning the lottery. That would be amazing. I
Hmm.
said, but I don't actually get to decide what your house is worth. The market does. And I want to help you figure out what the market might think your house is worth. And a lot of times I'm right. And sometimes I'm wrong. But the good news is we're going to continue to interpret the market and really be fluid and
Hmm.
active in interpreting what the market's telling us. And that is ultimately what your house is worth. Your house is worth what someone is willing to pay for it.
Exactly.
And so it's an exercise I try to spend a lot of time walking sellers through, because we've had these wild increases in our appreciation of our homes. It's been an unbelievable and unprecedented time in Canadian real estate history. And the good news is that's going to continue for people in our area in Windsor, Essex. There's so much good economic news here. Our prices are on the way up. We have a fundamental housing crisis nationwide. So there's really good news out there, but there still needs to be some rationality, and we use that. We try to I try to infuse that those conversations with data and with logic to say, here is what the market is telling you, regardless of what number sounds good in your head, because there's a lot of irrationality out there. And I take a lot of pride in educating my sellers, so when we put a
Mhm.
property on the market, it's at a number that is attainable and it's going to make them feel really good and be a great return for them, but is also fair in that marketplace.
I love it. And, you brought me back to my childhood when you said, it's only worth what the market says it's worth or what someone's willing to pay for it. And I remember the first time my dad told me that, I was collecting hockey cards and I was like, I want that rookie card. And I wanted, like, I was like, I will pay like the Beckett. I don't know if you
Yeah,
remember
the Beckett
The
magazines. Yeah.
Beckett guide. I don't know, those people who remember that. Maybe
Cards
it's
were a
still
big
around.
thing.
It was a big deal. And I was like, it says that it is worth, and I don't remember what the number was, but like, at the time, like call it
$8.
$20 or something. Right. And I'm like, $20 is pretty hefty for a little kid. And my dad looked me in the eyes and he said, he's like, it's only worth $20 if someone's willing to pay it. And I'm like, well, like I remember as a child thinking, that doesn't make any sense. It says it right here that it's worth $20 because, like, you go to the store and that's the price, and this is the price, and that's the price. But at the end of the day, it's like you don't understand that. But even people as adults owning these massive, assets, right? This home, which a lot of people would call as just an expense. So to your point about it not being an investment, like your home is something you live in, and we're just lucky that it appreciates in value, right? Like it also takes a lot of cost to maintain it and to, pay for property taxes and all of those things. So it's definitely not an investment. It's just, we're lucky it doesn't go down in value. So when I think about people who struggle with that, especially in a primary residence situation where they're like, I want to time the market, but then they go out and they buy the Denali or like this brand new car that's, like now it's like to get a fully loaded truck, you're spending over
Oof.
$100,000 for a fully loaded truck, and people are doing it, or they're leasing them for, $8, $9, $1,000 a month, and it's not even theirs. And yet it seems like there's no thought about it. It's just like, I need that truck, but that thing will go down in value. And yet this other thing, luckily, will go up in value. And yet, as we zoom out to 5 years, to 10 years, to 50 years, like Bert did,
Yeah.
it's like, it becomes like just like a detail that is going to be forgotten. Right. And when I look at the investment side of things, so we think about people who are listening to this show, you're thinking about investments, you're thinking about like, how do I build, my wealth? How do I build that legacy for my family? And in reality, it's like, it really just comes down to, is it a business or is it not? It's like an investment is a business. It's
Well,
like, will this thing
yeah.
earn some money? And of course, the appreciation is the bonus that comes off the back end of it. So if I don't get the timing perfect, it actually shouldn't matter as long as those numbers on the front end are making sense so that I can hang on to that for the 5, 10, 15, however many years it takes, so that you're not quote unquote upside down and you're making money off of this thing.
Well, I think you just kind of nailed it for some of these folks. Like you just said 5, 10, 15. Like it seems that if I'm hung up on timing the market and getting in the market in the right time, then it's like, timing the stock market, right? Like it's any market. It's really like, how long am I really here for? Like if it matters a lot if I'm only looking to, be in this market for 2 years, 3 years, under 5 years, right? Like it matters a whole lot if that's my mindset. If I'm here, I'm out, and I'm here, and I'm out. Like think about day traders or traders. Like that timing makes sense. Like you have to think that way. So if are these people that we're thinking about, are these people that we're talking about, are they thinking short term? Because if you're like what you said, it doesn't even matter. He bought a $45,000 house 50 years ago. Like it doesn't matter in 30 years what that house was, because it's going to be more. Like it like you said, Kyle, it's a moot point at that point, because it's like it's not really about like timing. It's about where's your mindset and your time horizon of really what you're here for, right? Like are you buying to stay in it long term? Like when we are buying our properties, like we're only looking long term. Like you're keeping it forever. Because we want to eventually maybe refinance it and then keep it rolling here. And it's like, we want that thing forever. So it doesn't matter that we buy it now. We buy it last year. It's about how long you vision this. So if you're going long term, who cares? But if you're going short term, it does matter.
Yeah. And like, Kyle, how long have we been? When did we buy our first property? Was it 7 years ago, 8 years ago?
Yeah, it would have been
our first property,
2016, July of 2016.
July.
I remember
Okay,
it like
so it was. Remember negotiating with that guy? So 7 years ago, we are already talking like old timers. Like we saw our first property triple in value, right? We're talking about the good old days when properties were cheap and plentiful. Like, it's like I sound like my father-in-law, when we have those conversations, but we've only been investing for 7 years, and you longer in the US, but like we have seen properties triple in value in that time. And so, the lesson, the takeaway for people is you have to participate. You have to get involved, because in another year, 2 years, 5 years, we'll be talking about the values of today like they were extremely cheap, right? Because over time, things only go up. And John, you're 100% right. We are not speculators. In fact, we hate flipping. I've got a flip going on right now. I hate it. I don't want to be involved in it. You guys,
how many times on this show are we going to talk about?
I was just about to say that. I was like, I feel like we've said this before, and you said you wouldn't do a flip again.
It landed in my lap. I had to buy it.
Oh my God.
But our time horizon,
it's like shoes,
long
Matt.
term.
It's like flips are like shoes for you. You're like, I can't resist it. I need another pair.
Well, and yeah, I mean, here we are talking about this. I've had 7 primary residences in 12 years, so I went from 170,000 for that first one that I have said, God, we should have kept that. We couldn't have kept it. We needed to sell it to buy the next one. And here we are 12 years later buying $1 million plus homes, and so that's how it goes. But I think the point is that it's real estate investing and investing as a whole. It is not a short game. We're not day traders. We are not speculators. We're not gamblers. We have made a bet on the greatest market in the history of humankind, the real estate market, right? And so we have this passive appreciation that we 100% know with full faith is going to go up year after year after year. Will it flatten out? Will we have dips? Absolutely. But over the course of time, over that long term that John's talking about, it will, without fail, go up. And that's what we're buying into. It is beyond our control. So we are focusing on the things we can control. And that's the difference, I think, in mindset. People want to blame the market for not getting involved, for not participating, for not buying. And that, my friends, is a huge, huge mistake.
Well, you remind me of a number of things. So I feel like a lot of people that have this mindset around like, I'm going to wait for prices to come down, or I'm going to wait for a crash, or I'm going to wait for blank. Oftentimes, while I don't have any, let's say, proof, but I'm going to say I strongly believe that people that are making these claims and making these statements are basing it purely on sort of just a guess. Like they haven't actually, they hear what's in the media, they saw a headline, they heard, whatever, but they actually don't know. And I think it comes back to, we've talked about it so many times before. It's like when you don't understand something, you don't act. So it's like, if you're worried about a housing crash coming down, happening because you read a headline, the next step would be like, if that's a concern of yours and you're hesitant to get into the market because that's a concern, then you need to do your research, and me being the fact finder that I am, is like, if I'm worried about that, it's like, I'm going to go down that rabbit hole and I'm going to figure it out, right? If you want to use macroeconomics as a guide for you, then you better understand what's going on in the market. Like when rates go up, like you need to ask yourself, well, why are rates going up? Okay, I go down that rabbit hole. Oh, okay, it has something to do with bonds, and bond rates. Okay, what happens when bond rates go up? Okay, when does that happen? Oh, it goes, okay, when when it looks like GDP is going to start slowing and the economy is going to start slowing. Well, why is that happening? Oh, jobs is going to, all of these things are connected. And there's a lot of data that can help you make these decisions. But ultimately, as you go down that rabbit hole, you'll start to learn what's happening. But then you'll also start to zoom out, because you're going to start looking at the big picture and go, oh yeah, like at the end of the day, it still comes back to, does it really matter? It doesn't. It's not going to matter. It's not going to make that big of a difference in the end goal, because one day you're going to be Bert and you're going to look back and you either get to say, my first investment property cost me $45,000, or if it's today, maybe it's $400,000. My first investment property cost me $400,000. And no one's going to ask you, did you buy at a top? Did you buy at a bottom? Did you buy right in the middle? No one's going to ask you that. But then they're going to say, what's it worth now? And if it's 10 years down the road, maybe it's worth 600. Maybe you're lucky and it's worth 800. Maybe you're luckier like we were, and maybe it's worth 1.2 million. It doesn't really matter. At the end of the day, is that as that time horizon increases, you're going to be okay. The one thing that you need to focus on, and I'm going to say it again, and I think this is going to be my big takeaway for the episode that I hope people take with them, is if I buy this property today, is it a true investment? Is this a good business decision? When you open a business, this is kind of like a Nelson Nash thing from, infinite banking, from becoming your own banker. If you read that, he talks about this idea of the startup cost of a business, because when you start up any business, there are costs, and nobody opens a business with the intent to only keep it open for 5 months, a year, 2 years. They open a business because they want that business to be open for a very long time. And oftentimes they don't see profit in the first few years. So when you think about investing in real estate, you need to think of it more as a business, which means there may be the potential for short-term losses, whether it's paper, like fictitious, like the value of the building. But at the end of the day, it's like, can I keep this business going? Can I keep the doors open? And can I keep my customers coming in, which is my renters, or whether it's commercial or residential? Ultimately, at the end of the day, you need to make sure that you can float this thing, and you got to be able to float it and be able to navigate the first few years, just like any business owner must do in order to become successful. And then at the end of the day, it's not going to matter. When someone says, hey, when McDonald's opened, was it a good market? Like, was it a bull market? Or was everybody going out for dinner? Nobody cares. All that matters is they made it past the hard part. And that, I think, is something that we want to keep in mind as we're investing, is that is the part that matters most, not where we are in the market cycle. Of course, if you're a speculator, you got to pay attention to that stuff. And if you don't know what you're doing in a market cycle, then you need to sit it out. But if you're doing it for business, then just make sure that you're in it and you're willing to battle that early, growth that you need to have.
Yeah, that sounds like a great takeaway there, Kyle. Like thinking about real estate as a business first, and putting that in terms of, the way a business would start up. That makes a lot of sense. And then it's really an investment second, business first, investment second. Matt, what would you say is a big idea you want to leave the listener with today?
Well, I think, it's really that, like, the pursuit of perfection is what screws a lot of people up here. Like, Kyle just talked a lot about timing the market. You can't time the bottom. You don't know the bottom of the market until the market is turned on its way up. If you were a real estate investing expert extraordinaire, then you would have known December and January were the bottom of our market. We're up 6% year over year from last year. We're up 8% from those depths in December, January. We're up 2% from July. So you can never know what the bottom is. So stop trying for it and just participate, get involved. The experts have been wrong time and time again through all of this. So, I would actually say you can be that fact finder and go and do that deep dive and try to figure it out for yourself. But I just think on a simpler level, I guess, I just want you to get involved and participate. Kyle is 100% right. You want to buy something with solid fundamentals. You want to buy something that's cash flow. You want to buy a good business from the start, but stop chasing perfect, because for so many people, that means that they never start because they're waiting for perfect. And perfect is gone. Perfect is in the past. So many of us, I was a history teacher before, we talk about revisionist history, which means like we rewrite history, or we remember history in a way where it didn't really actually happen. And a lot of us do that with real estate as well. Oh, 10 years ago, I wish I bought every property I saw. 10 years ago, I was just getting started and could barely afford my mortgage on a $170,000 house, right? So let's not remember things through that those rose tinted glasses. Let's take them for what they are. Let's control what we can, and let's get out there and be active and be involved and be participatory, because that's the only way that a few years from now you look back and say, oh my God, those 2023 prices were so cheap. I wish I bought every property I saw, because look at where prices are now. That is the only way to do it. And I hope that the blunt force of our message today spurns some people to get over their just like weird self-talk cycles where they're just waiting for that perfect property, where they're waiting for the market to crash, where they're just in this cycle of saying like, things are so expensive. Things are so expensive. Like I just had my biggest month of the year in August as a real estate agent, at the same time as hearing from almost every agent I encountered saying the market's dead. The market's so slow, complaining about the market, right? So you can be the factor that makes the difference if you're willing to put the work in, if you're willing to go out there and get it.
Love it. That's a great message. That's a great message, Matt, to end on. And let's call our folks to action. Like Matt has just called you out. Kyle has just called you out. Stop wasting time when this is these are the right moves. Just ask yourself, what's your time horizon? What are you in it for? Hey, we want to thank you for listening to another episode of the Invested Teacher podcast. If this is the first time you've listened, hit subscribe. If this is the second time, hey, leave a review.
Hit subscribe again.
Whoa, 2 times?
Yeah.
Might that
subscribe on your wife
unsubscribes them.
That'll unsubscribe. We don't want that.
Careful now.
Yeah,
careful.
Leave a review.
3 times. Do it 3 times.
Yeah.
I think it'll work out.
Your review, your 5-star review will help the show grow, but it also will help that other person who's trying to decide if real estate investing is the right move for them. It will speak to them just the way it's speaking to you right now. So please hit that subscribe button, share the podcast with your friends, your family, and you can follow us on all social media platforms at Invested Teacher. We're on YouTube, Twitter, Instagram, Facebook, all those things. So we'll look forward to seeing you over there as well.
Our passion for talking about this stuff and sharing with you comes through, I hope, in every episode. All links, resources, and transcripts from this episode can be found over on the website. That's investedteacher.com/episode 41. Again, that's investedteacher.com/episode 41.
Hey there, friends. As you know, I am engaging in all kinds of wealth architecture. Yeah, that's right. I'm hopping on calls with all kinds of invested students who are wondering about their future and setting themselves up, particularly those who are out there, maybe business owners, those who have corporate structures or maybe need a corporate structure. I've been doing a lot of calls. I'm having a blast helping people navigate in that land. Head over to investedteacher.com and you will see at the top there is a book a call button. I'd love to hop on a call with you and try to get you on your next step to make sure that you have what you need in order to move along your wealth building journey.
All right, invested students, class dismissed.
This is just a reminder that the content on this podcast is for informational purposes only. You should not construe any such information or material as legal, tax, investment, financial, or other advice.